Profit attribution to permanent establishments in India. What does this mean? Imagine binge watching your favorite Netflix series only to find out Netflix itself got hit with a 445 crore tax demand in India. Sounds like a thriller plot, right? In 2022, India's tax authorities argued that Netflix local unit should be taxed on nearly half of Netflix global profit for content viewed in India. Why? Because of something called a permanent establishment, PE, and profit attribution. Don't worry, I'm CA Pranav Goyal, and in the next 10 minutes, I'll unpack this drama in simple terms. We'll explore real cases, yes, including Netflix, explain what PEs are and why profit attribution is so controversial, and how global companies like Morgan Stanley and Formula One got embroiled in this issue. By the end, even a 15-year-old will get the gist, and CFOs will know the pitfalls to avoid. A PE, permanent establishment, is basically a taxable presence of a foreign company in another country. In tax treaties like Article 5 of India's treaties, a PE usually means a fixed place of business through which the company's business is partly or wholly carried on. In plain terms, if a foreign company sets up something stable in India, say a branch office, factory, a workshop, or even a significant agent or server, that can be its PE in India. Once a PE exists, India gets the right to tax the profits attributable to that PE's activities in India. Think of it like this. If a company is doing business in India, not just selling remotely, India wants its share of tax from the money made here. For example, if a US company has an office in Mumbai or an employee in Delhi, regularly finalizing contracts, that could be a PE. Even a few days of business can count. As we'll see in the Formula One case, where a 3-day racing event created a PE, essentially, a PE is like saying, you're effectively operating in India, so you must pay taxes here on the profits from those operations. Profit attribution means figuring out how much of the MNC's total profit is due to the PE in India. In other words, what slice of profit pie belongs to India. This process is notoriously tricky and often contentious. Different countries have different rules, and if they don't agree, the same profit can get taxed twice. Ouch. Or not at all. Taxing. For tax authorities like India's, the challenge is to tax a fair share of profits from the local market. For companies, the goal is to avoid an unfairly large chunk being taxed in the high tax jurisdiction. India's corporate tax rates are significant. Why is it so controversial? Because there's no single formula globally. India may say, hey, a big part of your sales and users are here, so a big part of profit is ours. The company may reply, but all the heavy lifting, technology, capital, risks is done abroad, so only a small profit should be taxed in India. Both sides have a point, and this tug of war leads to disputes. Add in the digital economy, where you can earn revenue in India without having a physical presence, and you have a recipe for debate. In summary, who gets to tax how much profit is a grey area, leading to court cases and even changes in the international tax rule. In the Netflix story, the tax department thought Netflix's India's arm was more than just a distributor. They believed a large portion of Netflix's global content profits should be attributable to India. Netflix argued otherwise. Such conflicts are common now, which is why profit attribution is a hot topic in international tax. Over the years, Indian courts, including the Supreme Court, have weighed in on PEs and profit attribution. Let's look at 4 landmark rulings. These real stories will make the concepts clearer. First, Morgan Stanley 2007, outsourcing and the arm's length principle. So what's the story? Morgan Stanley, the Wall Street giant, had set up a captive back office BPO in India, Morgan Stanley Advantage Services MSAS, to handle support services. The question, by outsourcing work to India, did Morgan Stanley US create a PE in India? And if yes, how much profit should be taxed in India? What the court said, the Supreme Court of India gave a big sigh of relief to the outsourcing industry. It ruled that simply outsourcing back office operations to an Indian affiliate does not automatically create a PE. In Morgan Stanley's case, they did have some employees in India on short assignment. But the courts found no additional taxable presence beyond perhaps a limited service PE. Crucially, the court stated that if the Indian affiliate is paid an arm's length price for its services, that pretty much settles the tax issue. In other words, Morgan Stanley US had paid its Indian company a fair market price for the support work, TP compliance, and so no extra profits needed to be attributed and taxed in India. This principle, pay a fair price to your Indian entity and you won't be taxed twice, has become a cornerstone. It's like saying the transfer pricing adjusted profit in the Indian subsidiary covers what India can tax. The foreign company's PE won't be asked to cover up more. Why it matters? This 2007 ruling set the precedent that double taxation should be avoided. You don't tax the foreign company's profits in India again if its Indian arm already earned and paid tax on a fair profit margin. It encouraged MNCs to structure Indian operations as separate companies or proper contracts and to document arm's length pricing, knowing that would protect them from extra PE profit claims. Fun fact, tax rate on foreign companies' PE profits in India would have been around 42%, which could wipe out cost of savings of outsourcing if applied. No wonder this case was vital for BPO. Formula 1 2017, 3 days, 1 PE story. In 2011, India hosted its first Formula 1 Grand Prix at the Buddh International Circuit in Noida. The Formula 1 World Championship, a UK company, had rights to the F1 racing event. They had a complex contract with an Indian organizer, JP, for the circuit and promotion. The tax question was, did FOWC, Formula 1, have a PE in India during the race? It was just a 3-day event. Can that really be a fixed place of business? What the court said, the Supreme Court in 2017 gave a resounding yes. Formula 1 did have a fixed place PE at the race circuit. Also, the court observed that Formula 1 had full access and control of the circuit for the duration of the event. Effectively, the racetrack became their place to conduct the event. A key test for a fixed place PE is disposal or control of premises, and Formula 1 met that. As a result, payments made to Formula 1 for the event were deemed taxable in India. JP, the payer, was obliged to withhold tax. The Supreme Court sent the case back to the tax officer to figure out profit attribution based on the facts. What happened next? With Formula 1 confirmed to have a PE, the tax authorities had to determine how much of Formula 1's global racing profit was attributable to the Indian race. Initially, an officer tried a simple formula: total global profit divided by number of races in the year. If Formula 1 had 20 races worldwide, one race equals 1/20th of the profit to India. The company objected. Finally, a detailed analysis was done considering 9 performance factors like F1's branding, race execution, R&D, etc. to judge how much value was created in India versus abroad. The result was striking. About 56% of the total profits was attributed to the Indian event and accepted by Formula 1. In simple terms, the Indian Grand Prix was calculated to generate over half of Formula 1's profit for the year. That 56% of profit was then taxed in India using ratio of India's race revenue to global revenue as a multiplier. Why it matters? The Formula 1 case showed that a PE can arise even for a short-term project or event, and that profit attribution can be significant if the local activity is a big part of business. It underscored the importance of facts because so much of the F1's event's value, audience, sponsors, live event execution was tied to India. A large profit chunk was taxed. It also demonstrated how, in absence of clear records, Indian tax authorities might use Rule 10, an apportionment rule, or creative factor-based analysis to attribute profits. For CFOs, the lesson is even short ventures in India need careful tax planning. A few days of business could trigger a tax bill. Third important judgment is e-funds in 2017, when back office support doesn't create a PE. What's the story? eFunds Corporation, a US company, had an Indian subsidiary, eFunds India, providing IT-enabled services. The contracts with clients were in the US company's name, but execution of services was largely done by eFunds India. The tax department argued that eFunds US had a PE in India through the subsidiary, either as a fixed place or as an agency PE, since so much work was done here. The case went up to the Supreme Court alongside Formula One in 2017. What the court said, the Supreme Court took a close look and actually held that eFunds India did not constitute a PE of the US company in this case. Essentially, they found that the Indian entity was not a place at the disposal of the US company. The Indian company carried out work in India, but it did so as a service provider on its own premises and not as a mere extension of the US company. Also, the contracts were with the US entity, but all execution was subcontracted. The Indian company's work alone didn't automatically mean the foreign company had a taxable presence. This was a case where the formal separation paid off because the Indian subsidiary was independent enough. eFunds USA avoided a PE claim. However, here's an interesting twist. The lower tax tribunal, thinking there was a PE, had developed a formula to attribute profits, somewhat like a thought experiment. They suggested allocating profit based on the proportion of assets in India and then subtracting the Indian subsidiary's own profits to avoid double counting. The Delhi High Court noted this method approvingly, but since the Supreme Court ruled no PE, that profit attribution formula didn't end up applying. In effect, eFunds USA paid zero Indian tax. Its Indian subsidiary, of course, paid tax on its own earnings. Why it matters? Because eFunds reinforced that having an Indian subsidiary do work doesn't automatically create a PE, especially if you structure it well. Proper contracts, the foreign company not controlling the Indian offices, etc. It also highlighted the principle of avoiding double taxation. Even if there had been a PE, profits attributable would exclude what was already taxed in the subsidiary. For multinational groups, this case shows the value of maintaining clear boundaries and documentation between parent and subsidiary. It can be the difference between no extra tax versus a big tax hit. Now coming to the latest Netflix court case. What's the story behind it? Well, Netflix, the streaming services we all know, operates in India through a subsidiary, Netflix Entertainment Services India LLP. This entity's job was basically to market and distribute subscriptions. It didn't create content or own the technology, which remained with Netflix US and other affiliates. For the tax year 2021, the Indian Tax Department came in with a shocker. They recharacterized Netflix India as not just a distributor, but a content and technology service provider to its foreign payment and hit it with a massive 445 crore TP adjustment. They applied an other method calculation akin to saying Netflix India should be earning a huge royalty or fee for the content and tech use, which implied attributing about 43% of Netflix's subscription revenue as taxable profit in India. So what's the tribunal said? The case went to the Income Tax Appellate Tribunal in Delhi. In 2022, the ITAT sided with Netflix. The tribunal found that Netflix India was rightly characterized as a limited risk distributor. It did not create content, did not develop tech, and bore minimal risk. All the intellectual property, algorithms, and content library were held by Netflix abroad. So why should the Indian unit get 43% of profits? The ITAT noted that giving a company with no ownership of IP such a large profit share goes against the grain of FAR analysis. Essentially, they said the tax department's profit attribution was way off base. Netflix India had tested its margin about 1.36% using the standard TNMM transfer pricing method and found it fair. The tribunal agreed a low but arm's length profit margin is appropriate for a distributor. They threw out the rupees 445 crore adjustment entirely. Why it matters? Because the Netflix case is a wake-up call for digital and tech companies. Tax authorities are trying new tactics like recharacterizing transactions to bring more income into India's tax net. Basically, a backdoor way of attributing profits to a PE even when there isn't traditional PE. Netflix India was an actual local company, so no dispute of a PE in treaty sense, but the fight was over how much profit should be taxed in India. The tribunal's decision upholds the principle that you only get profit in line with what functions and risks you have, a fundamental tenet of transfer pricing and the OECD approach. It's a win for digital businesses to not be arbitrarily taxed on worldwide profits, but it also shows Such businesses must document their arrangements very clearly. In Netflix's case, the distribution agreement and terms of use clearly showed the Indian entity had no ownership of content or technology. This clarity helped sway the decision. So, what was the main key takeaway? If you're a company with digital or IP driven services, your structure and documentation better make it crystal clear what your Indian arm does or doesn't do. Otherwise, you might face a huge tax claim trying to attribute global profits to India. Netflix saga teaches that when India's tax man comes knocking, a well prepared transfer pricing defense can save the day. These cases reveal a common theme: the dance between transfer pricing and PE profit attribution. In Morgan Stanley, since the Indian affiliates' profits was arm's length, the foreign company's PE was seen as adequately compensated. In e-funds, the courts were mindful that the Indian subsidiaries' profits should not be taxed again in the hands of a foreign PE. And in Netflix, the dispute relief was essentially about how much profit should be in India versus overseas, which is the essence of profit attribution. The golden rule emerging is, if you pay your Indian entity fairly for what it does, you greatly reduce your PE risk. But if the tax authority feels the Indian side isn't getting its fair share, they will either create a PE situation or use TP adjustments to grab more profits for taxation. Hence, transfer pricing compliance is your first line of defense against excessive profit attribution to a PE. So, how do we determine the right amount of profit to tax in India? Broadly, there are two approaches: the OECD's authorized AOA approach. Think of it as a standard international method.